So I have a simple chart. This is a monthly, but let's maybe go to a daily because I know that's probably a little bit more popular. So here's a daily chart of the S&P 500. And I'm also going to switch it down to the SPY ETF, which is actually tradable versus the SPX. Okay, now I've applied two moving averages. We have the red moving average here, the blue moving average. They are both looking at the same number of bars, same number of daily data points, but they are plotted differently. They're both looking at an average price of the same number of bars, but they are giving us a different value at the end point and throughout its history. That is because the red line, as you can see, follows price more closely. So as price trades down, the exponential line follows it closer, and the simple moving average stays further behind and it's a little bit smoother, doesn't react as quickly. So I'll just pull this up. You can see 50 period for the simple moving average and a 50 period for the exponential average as well. So what this brings up, this is a very common thing to see a 50 period moving average put on a chart for a trader. And you may even see a comparison or at some point trying to decide between an exponential and a simple moving average. And that decision usually is made by just looking for evidence of more people looking at one than the other. And the difficulty with that is there's only a limited sampling of people sharing their charts or sharing videos of their charts. And even then, that may change the minute after the video has ended. So there's not a lot of information. Then you can go search on Google for which one's better in comparisons, and you're going to find a lot of technical analysis charts looking at an analysis of a certain index or stock or ETF or currency pair or anything like that. What we're looking for now is we're not looking for observation and interpretation. We're going to look at statistics. That's what we're going to be pulling and trying to answer the question which one is best. So when you see these lines, a lot of assumptions can come up. You can say it looks like when the exponential crosses below the simple moving average, that is a trend. Or it looks like whenever you get too far away, it comes back. There's a lot of observations like that that you can make. And then going back further here, so during a trending environment, it's easy. So if you're only looking at recent information or you're just looking for examples to prove the concept that you have, you can say, well, a crossover would be a good trend indicator. So here's a crossover, and it takes you all the way up to here and then crosses over. The important thing to look at is make sure you understand where price is when that happens. So price is up here on the crossover, rides all the way up nicely, but before you finally get the turn down, it may be too late often for you to capture any of that actual move in the market. So and here's one here where it crosses down, and you may think that's a good short signal or a good sell signal. So we're under, you're either short or out of the market, and you can see this rally all the way back to a new high before a new signal's made. So that's one example. Then you go look for more. Say, well, maybe that's not the best. Maybe it's some type of mean reversion example. So you go looking for a mean reversion, say, okay, here it's above, it comes back, it's below, it comes back. But then there's times where it gets above and then stays above for several months. So you say, what can we do with this information? Should I change the look back? Should I make it shorter? Make it 10 periods so I have more frequent signals, more frequent opportunities? And that's where you run down this rabbit trail of trying to figure out what to do with this tool. So it's like finding that automatic nail gun, hearing about it, knowing there's got to be something valuable to do with it. But if you don't know how it works, you don't read the instructions, you might actually wind up hurting yourself rather than helping yourself with something that could be a good tool. So what I'm going to do now is actually write a little bit of script that is going to help us get statistics and figure out which is better, simple or exponential moving average. What is it better for? Is it a trend signal? Is it a mean reversion signal? A crossover signal? And what look back is best? So that's a lot of questions to answer. And the fastest way to get that answer is through writing an algorithm or an automated backtesting system here, and we're going to get that information very quickly. So create a new strategy. I'm just going to call this one simple versus exponential. Okay, test. All right, and just because this isn't a code writing system, I'm going to go ahead and pause the video and get this written out so you don't have to watch me type for a couple minutes. All right, I have a simple script written here, and that is, I'll go over it quickly so you can see what is here. I have some inputs that we can change, and this is what's going to help us find which one's best. So this is, I have this little code put in here. It's just called x0s1, which means which one are we going to use? Exponential, I'm going to put in a 0. If I want to use a simple moving average, I'll put in a 1. Then I also have the look back at 20 periods. That's the initial value of that. And then I can also change that or optimize it, give it a range of values to test. Then I'm just calling the average, AVG. The type of average will be defined. So if it says if the type of average is exponential by putting in a 0, then AVG is going to be an exponential average. If I set it to 1, then the AVG is a simple average. So that's what those terms mean. Those are pre-built in TradeStation to make it simple for us. Then here's the very simple test we're going to run. And I believe that the best thing to do when testing a system, when testing a system is to break it down to every individual component and test those individually first. So starting very simple, starting with the key elements and make sure you understand which parts are best. Wrap that, put a bow on it and say, okay, I've made that determination. This component is very good to have and include. Then you can go on and test other things. But if you include too many things, like trying to test which moving average is best and is it better for a crossover, mean reversion, or trend, doing all those at once is going to be too difficult. So we're just going to figure out which one of these is best for a trend. Very simple. And for that, we're going to say if we close above the average, then buy the next bar. If we close below, then we're going to sell. Very simple. Many traders go short, but most traders do not. Most traders, investors do not go short. So we're going to not go short on this one. We can add that back in and test that as well and see which one is best. But I believe that going short is not as easy as going long, and going short should be a different type of system. But we can test that both ways just to see what it looks like. And if you would like to share your opinion on that, if you want to see me go long and short on every signal all the time in the future, go ahead and share that, and I'll incorporate that feedback as well. So that's done. Let's see if I did it right. I did. So that's been saved, and I'm going to move that off to the side here, and I'm going to insert that strategy. If I can remember what I called it. There we go. So here it is, ready to go. We have it set to exponential and 20 bar look back. So I'll just set that up there. What I'm also going to do is change the indicators to match what we're looking at. So remember, red is the exponential, and having the visual indicator on there helps us know that the code is working correctly. So here we're closing below the exponential average, and then we finally close above, so the next bar is bought, and then we close below, so the next bar is sold. Then we close above, the next bar is bought, we close below, the next bar is sold. So that is, we see that the signals are working correctly. We trade down, it comes back, it crosses back above the red line and closes. So then we buy the next bar, it runs up, we close below, and then we sell. Alright, so that's working as we planned. We can see in sideways markets there's a lot of red lines. So in case you're not familiar, just a bluish line here, that is an indication of buying here, selling here, and the trade being profitable. If there's a red line, it means you bought here, you sold here, and the market was lower, so it was a losing trade. So that is the what those lines look like. And then here's a nice big win where we close above, and then it goes for a big run, gets out here, even has one more last win here before a nice pullback like that. So here all we're doing is just observing that it's functioning correctly. We don't have any sizing parameters in here. It's just simply buying 100 shares, it looks like, based on this number here. So that is something else we can add later, but to keep it simple, we'll just look at that. So then I can look at this equity curve report. All right, and this is only a 2-year period, which is not enough evidence to throw this away or not. So let me go ahead and add some more time. Make this a 10-year chart. All right, so here's our 10-year simulated equity curve. If we bought when the market closed above the 9 moving average, exponential average, and sold when it crossed below. And that is a 20 period look back. So we can see 10 years of data, we end up about where we started, barely ever going into profitable periods of time. Obviously our big drawdown here is the 2008, where every time we cross above, the market gets yanked back down in this bear market. The recovery barely takes you back to above break even, and then more recent selling in the summer of 2015 has pulled you back down again. So this is not looking so great. Just kind of rearranging stuff here so I can get to it easier. So now what I can do is I can go and see, let's try the simple. So all I do is set my exponential versus simple to 1. All right, and then finish that. Now we see, if we look here, let's look for one to ensure this is happening correctly. All right. Looking for one where it closes above the simple, which is the blue, but which is a different signal than the exponential. Looking for time, the lines are pretty far apart. It's very similar. Not seeing one, but how we can probably see faster. Here's one. Okay, so here, if we had on the exponential, we'd closed above here, we would have opened the trade here. But on the simple, we had to wait all the way until it closed up here to buy here. So that's the nature of simple versus exponentials. The simple moving average is always going to be slower to get back in. So here is the equity curve of the simple moving average on our 20 bar look back. Buying above, selling below. So buy when it closes above, and then sell when it closes below. 10 years, same look back, same data, same index, same ETF it is, and we see that we have a better return. We have a similar pattern. It goes up, it comes down through 2008, it climbs back up, and then it goes down more recently. So we have the same pattern, same market conditions being thrown at it, but we have a better equity curve. So still not quite enough information yet. I want to keep digging through this, but so far in two tests we have simple coming out a little bit better than exponential as far as at least the 20 period moving average goes. So now there's a little technique and we teach this in the SMBU Systems Foundation class about optimization and algorithm development, but I'm just going to run through it quickly and show you that one way to do this, the slow way. I'll show you the slow way first. Slow way to do it first is I could say, all right, that was simple moving average 20, so now I want to see what 30 looks like. So I'm going to switch to 30 and close that and come back here and say, okay, not better. And then I can go back and say, all right, well, 30, going slower didn't work, so let me go faster. Let me go to 10. We can close that and say, oh, that's even worse. So now I'm starting to get a little discouraged. I'm saying, well, is 20 really going to be the best because it wasn't that great? So I go to 40, and you can see this is going to be a very slow process, still not looking good. And then I can say, well, what if it's a slower moving average and I switch it back to exponential? So I hit that and I close that. So you can see this become a very tedious process, which, by the way, look at this. That got better. But now I'm trying all these different things and it seems random. Which one's better, which one's worse, exponential versus simple, slower versus faster, and trying to keep track of all that. Well, we can do that automated through a process called optimizing. So what I was just doing was kind of a manual optimization. I'm trying a lot of things, and what I would do if I was actually manually optimizing this is I would document the results of each of those tests. More so, even close this. I would come in and not just look at the equity curve. I'd get the statistics here of the profit factor of the trades, percent profitable, etc. Alright, so what I'm going to do instead of doing that manually is I'm going to automate the process of testing these. So I can optimize each of these parameters automatically by saying, here's the range I want you to test. I want you to test 0 and 1, and in an increment of 1 because we only have 2 values. So it's going to test 0 and 1. Okay, that's very simple. That would only be 2 tests. But now I'm going to go in and say I also want you to test everything from a 5-period moving average up to a 200-period moving average, and I want you to do in increments of 5. So now we have, it's going to test the 5 simple moving average, the 5 exponential average, the 10 simple, 10 exponential, 15 simple, 15 exponential, etc., all the way up to the 200 moving average, exponential, and simple. So I have one little thing I have to fix here. If I'm going to look at 200 bars, I have to let it see 200 bars. So 0 and 1, and then I have to optimize 5 to 200. So we see 0 and 1 and 5 to 200 in increments of 5. I hit OK. I'm going to test them all. So that's 80 back tests that are going to be run. So you saw I was doing that manually. I'd run a test and look at it, run a test and look at it. It's going to do that 80 times and give me a single report to compare all of those tests. So I click that. Let's see how long this takes. Literally, look, about 3 or 4 seconds. Took about 3 or 4 seconds to get that information. And the performance graph comes back. This is the equity curve of technically what had the best return. Doesn't mean it's the most tradable or the most reliable, but technically had the best return. And then I can get this other report, optimization report, and this gives me a list of all of the strategies that came back, and we have it by test number, but I'm going to sort by profit and see what tends to come to the top. Alright, so here's all the most profitable back tests, and we get all of them. So here's a very interesting information here. Very interesting. And by the way, I did not do this before. I didn't, like a cooking show, I didn't make this before and then redo it for you. I actually had not run this test, so I'm doing this live and really discovering this firsthand for myself. So I'm finding this very interesting. Only 5, 1, 2, 3, 4, 5, 6 it is, 6 of the back tests were negative over 10 years. Very interesting. Then the rest, 84 versions of this strategy were profitable. That is what we call robust. When you find a test where 60% of the back tests lose money, 40% make a little, and 3 of them make a lot, and you optimize it and find the one that made a lot, that it would be curve fitting. You are finding what just happened to work. That is not dependable or reliable information. But when you have most things working, and now you're just going to look for what tends to work best and what tends to not work best. So let me get my little drawer here. So what we see is down here at the bottom, I want to ask, what is it down here that doesn't work best? Okay, so what do I see? I see a bunch of zeros and 2 1s. And we know that zeros are exponential. So the exponential down here, all right, exponential, what's another pattern we see? The shorter lookbacks, 5, 10, 25, 10, 20. So all of these fast lookbacks and exponential averages, so fast exponential averages for a trend signal were not profitable. All right? exit out of that, and then go to the top, and let's look for a pattern at the top. So at the top, let's look at the top 10 or so. We have a pattern here. We have all ones for the top 10, and then a mix below that. Some exponentials come in as well, but what rises to the top are the simple moving averages, and we also have slower and longer lookbacks. 185, 200, 195, 90, 180, 165, 160, 170, 155, 175, 180. We drop out of the top 10, we start seeing a mix of other things, 60s, 50s, back closer to the 200s, but using exponentials. So there's a pattern I'm seeing here, that the slower simple moving average tends to have the best return.